Well, welcome everyone. My name is Creon Butler, and I'm the director of the Global Economy and Finance program at Chatham House. And Chatham House is really delighted to be a knowledge partner for the Delphi Economic Forum again this year, and to be able to contribute to an extraordinarily interesting and diverse program of events. This event will focus on a key question facing international policymakers, sovereign governments, and financial market participants today, which is how to deal with mounting levels of sovereign debt in emerging and low-income countries. This has both a short-term aspect, as a number of countries are already facing acute debt distress, but there is also the longer-term question around a large number of countries who may be able to service their debt at present, but where the long-term prospects are much more uncertain. There is also an issue that has to be looked at alongside other major international challenges, such as the rollout of vaccines in the developing world and the response to climate change. And it is one where policy is moving very rapidly, and the next key event is likely to be the G7 finance ministers who meet in early June. Now, we have a really excellent panel to address this question, and I'm very grateful to them for being with us today. In order of speaking, I'm pleased to welcome David Lubin, who is Head of Emerging Market Economics at Citi and also an Associate Fellow at Chatham House. In addition, Isabelle Mateos Lago, who is Managing Director and Global Head of the Official Institutions Group at BlackRock, and Yannis Manuelides, who is a Partner and Head of the Sovereigns and International Institutions Practice at Allen & Overy. And more details are available on the biographies in the conference program. But I should just mention that all three of the authors have published on the issue of international debt. And in the case of David and Isabelle, they've actually recently authored two papers that appear in a Chatham House project on rebuilding international economic cooperation, which can be found on our website. Now, a few quick housekeeping points. Each panelist will make some initial comments for 5 minutes or less. We'll then move to a panel discussion where I will pose some follow-up questions. And if there are questions from the audience, I will work them into that section. So I'd very much welcome the audience in posing those questions. And just a reminder that this is an on-the-record discussion. So we have just 45 minutes in total, and we'll aim to keep a brisk pace. So David, over to you for your introductory comments.
Thank you very much, Creon. Hello, everyone. For decades, if not for centuries, debt crises among emerging economies have been almost entirely associated with foreign exchange shortages. Typically, developing countries borrow in other people's currencies, and crises happen when developing countries can't get hold of enough of other people's currencies to service their external debt. In that sense, I think a number of people have had a tendency in the last 12 months to over-worry about the possibility of a systemic debt crisis in emerging economies. Now, of course, I don't want to kind of minimize the problems being faced by countries like Chad or Zambia or Ethiopia, the three countries that have applied for debt relief under the Common Framework, or for other countries like Ecuador or Lebanon who have had or are going through problems associated with excessive debt. The only point that I really want to make is that the idea of a systemic debt crisis related to foreign exchange denominated debt in emerging economies, that kind of systemic crisis, I think, has a very low probability indeed right now. And I say that for 6 reasons. The first is that US interest rates are phenomenally low by historical standards. At the moment, in inflation-adjusted terms, the 10-year bond yield in the United States is minus 80 basis points. It seems to me crazy to think that a systemic emerging markets debt crisis can take place when the cost of servicing dollar-denominated debt is so low, at least in terms of the risk-free rate, that's the real US 10-year yield. So low debt service costs are one factor. The second is that commodity prices, on which many developing countries rely, are at levels that we haven't seen since 2012. Non-energy commodity prices have gone up by something like 40% since April 2020. And, people are talking about a commodities super cycle. Again, the idea of a systemic debt crisis at a time when the commodities on which many emerging economies rely for export proceeds could take place, that seems to me wrong. A third point is that global trade growth is accelerating because of the efficacy of vaccine rollout in the developed world, particularly, notwithstanding the tragic situation in India, and also because lockdowns have been relatively effective. So trade growth is accelerating at a time when trade growth is accelerating. Also, it seems to me very unlikely that a systemic emerging markets debt crisis could take place. A fourth reason is that emerging economies these days have relatively limited needs for external financing. That concept, a country's need for external financing can be, more or less proxied by the current account balance. Crises in emerging markets tend to take place when countries have current account deficits, but developing countries these days, in the aggregate, are running a current account surplus, the like of which they haven't seen for 15 years. And so again, at a time when current account balances are strong, it seems the wrong time to think that a systemic debt crisis is going to happen. Two final points on this. The first is that the actual cost of servicing debt, the debt service ratio, is low by historical standards. And finally, the relationship between a country's external debt, its dollar-denominated debt, and dollar-denominated assets is currently quite favorable. And that's because many emerging economies have spent the last 20 years assiduously building foreign exchange reserves precisely in order to kind of protect their external balance sheets to minimize the risk of this kind of crisis. And that's my first recommendation, that now that the chances of a debt crisis are relatively minimal, now is the time to make hay while the sun shines. And making hay while the sun shines, in my view, on this issue in particular, is to make it very clear to emerging economies that they must pay attention to what I just called the foreign exchange balance sheet. In other words, not to let external debt stocks rise massively above their levels of external assets. That is something that we've got space to do, and I hope by making more use of the IMF reserves adequacy framework, we'll be able to do it. In my last minute, I'd just like to make one point. I think that the chances of debt crisis are more worrying at the moment in countries like South Africa, Brazil, and possibly Mexico, where it's domestic debt, not external debt, that may present financial stability risks. And I say that it's an odd thing to talk about precisely because, as I said at the very beginning, a domestic debt crisis in emerging economies is something we've basically never really seen. But countries like Brazil and South Africa face, in my view, a kind of doom loop between rising levels of domestic public debt and very weak and declining growth potential. And I think GDP-linked bonds, which perhaps we come back and talk about a bit later, may be a solution to kind of break that doom loop that I think exists in a number of countries, South Africa and Brazil being the most prominent, where very, very steep yield curves reflect, in my view, this negative feedback loop that exists between rising public debt levels and diminishing growth potential. Thanks.
David, thank you very much. I think there's some really important points there, and hopefully we can get into them in the discussion. Isabelle, over to you next.
Thank you very much, Creon. It's a pleasure to be here. So let me start by maybe adding to some of the the positivity that was conveyed by David just now in terms of how this particular global debt overhang that we're facing is maybe not as scary as some of the previous ones, or the situation the world faced after the global financial crisis. The first thing is that even though the debt increase is absolutely massive, it is mostly concentrated in the debtors that have the greatest capacity to bear that burden, namely advanced country sovereigns. An increase in 25%, 25 points of GDP in debt. For EM, it's much lower. It's more like 10 points of GDP. For the developing countries, it's more like 5%. And then private sector, by and large, is looking okay. Second point, David touched on that. Interest rates are at historic lows, and as a result, debt service is at historic lows, at least for developed countries. There we have, their debt burden about 50% higher than in 2007, 50% of GDP higher than in 2007, debt service 1 point of GDP below. It's true also for emerging markets, although to a much lesser extent. It's unfortunately not true for the low-income countries. So I'll come back to that. So the good news doesn't apply to them. And then the last element that I think is a big difference to the previous post-crisis period that we faced is that the lessons of the last one have been learned, and policymakers across the world are very much focused on growth instead of rushing into fiscal consolidation, which we know delivers neither growth nor fiscal consolidation. So that's all good, but it doesn't mean that the current situation is sustainable in the sense that it can carry on smoothly forever. For one thing, the low interest rate situation has a lot to do with the fact that central banks have been absorbing a lot of the net issuance from sovereigns. That is not going to last forever. I think as people are more intensely focused after yesterday's CPI release in the United States, inflation pressures are coming back. That was also very clear in the Q1 earnings calls from pretty much corporates across the board are seeing higher prices, higher input costs, and are very much hoping to pass them on to their customers. So we're going to be in a very different inflation environment. Central banks are going to start normalizing. Secondly, the current levels of public deficits are well above what can be justified over the longer term, even if you take into account the sort of Ricardo Rice analysis that there's a craving, a bubble for safe sovereign debt that is making it possible to run deficits forever after. Yes, maybe, but not at 10% of GDP, as is the case for the world average this year, or even 5% of GDP as the IMF expects for next year. So deficits are too high. And when you look at politics, pretty much in any country, there is no constituency for fiscal rectitude right now. That's certainly in Europe, it's kind of disappeared. In the UK, in the US, nobody's asking to raise taxes or cut spending. So there's a bit of an issue here. And so as a result of all this, it's a safe bet that interest rates in developed markets will rise. If all goes well, that rise will be very smooth and very contained. But that's kind of a strong assumption. And so that has important implications for developing countries. Why? Well, because in any case, they will have to absorb the developed market driven tightening in financing conditions. What can they do? Or what can one do? Well, at the national level, the only room for maneuver that they have is, don't make it worse. Don't make it worse. And that means two things. First is deal with the COVID impact on the economy as well as they can, as swiftly as they can. But there's only so much that they can do, as we know. And then, make sure that they keep the credibility of their central banks. Inflation pressures are even stronger and clearer in many developing countries as they are in advanced countries, a number of these central banks have engaged in quantitative easing last year. How they get out of that, how they start normalizing policy will be very important. If they appear to go into a kind of a fiscal dominance mode, then their financing costs on global markets will rise even more than just translating the impact of advanced country interest rates. But the main area for action to help emerging markets deal with this new environment that we're moving towards is really at the global level. And here I'd like to stress three things that could be looked at. The first one is help bring forward the reopening of these economies, and that's got everything to do with vaccine rollout and helping developing countries vaccinate their populations as quickly as possible. Secondly, liquidity provision to avoid constraining pandemic relief and pandemic-related spending. There, it's one of the few areas where action was relatively swift by the international community, and that's in the form of the 500 billion SDR allocation that was decided at the last IMF spring meetings, G20 meeting. This should be effective within a few months. That will be a meaningful help. But then that only goes so far. And so last point, really important to explore new solution to create fiscal space for emerging markets, not only to finance their recovery from the crisis, but also to deal with the needs of the energy transition in a way to finance their own Green Deal. In Europe, we had the recovery and the recovery fund that has created that fiscal space. We need something similar for emerging markets and developing countries. That could take a number of forms. One would be leveraging the SDR allocation, of which we know a large part will not be used at all by design. Another possibility, considering new one-off lending facilities from the IMF. The IMF has unused resources close to $1 trillion. It's a real pity not to make any use of that. And then third avenue of reflection that could be looked at is different types of initiatives to help facilitate the growth of sustainable emerging market debt. There is appetite for that in the global investor community, but right now these markets are very nascent and much could be done to facilitate their development. So let me stop here and turn it back to you, Creon.
Isabelle, thank you very much. And I hope we can look at some of the possible uses for that sort of SDR surplus, as you describe it, later on. Brilliant. And Yannis, over to you for your introductory comments.
Well, thank you very much, Creon, and thank you for having me here. So I will try to dive into some of the more specific things that have been happening and sort of commenting on those. And the last year, there has been an effort to deal with the unsustainable debt by making various proposals. One of them was a proposal to suspend debt service for the poorest countries for a short while till the end of this year. That was just mere postponement. And then a proposal to revive an old mechanism that we have, the Paris Club-led restructuring with the inclusion of economies such as China. And that would be restructurings of debt, of unsustainable debt, or just merely illiquid situations in various countries. And that was the so-called common framework, which, as I said, is meant to be an initiative taken by the official bilateral creditors, the various countries lending to the sovereigns under distress, with the participation and the comparable treatment of the private sector. And that has been a proposal that has come through. So far, as you, I think, mentioned earlier, Creon, 3 countries, or maybe just David, 3 countries have applied for this, Ethiopia, Zambia, and Chad. We do not yet know how this is going to proceed, but I think everybody, is fair to say, is watching on how this will happen. And I think everybody wants this to be a success. And what would be a success? I think it's important to sort of focus on that. So for the debtor country, clearly to emerge with a sustainable debt profile and be able to attract from all relevant lenders the additional financings it needs. Exactly what Isabelle was saying earlier. For the markets to be persuaded that this is not simply a new, that it is a new and better iteration of a well-known platform, the Paris Cloud platform, and indeed the platform that has been used with by the IMF, with IMF's sort of central role coming in with rescue funds. And that it is not the beginning of a new scheme that will bring just the sword of God on the creditors. And for the official sector, that it is going to be a success if it can show that it has that its proposal that initially was less than well articulated can be implemented with transparency and credibility and a legitimacy of process and within a reasonable time. And this in particular, the transparent way, with a common basis on debt sustainability and the positive participation of China, which is the largest creditor in many of these relevant countries, is very important. And lastly, I think for the world and kind of countries that may be facing illiquidity, that is one of the challenges that Isabelle noted, to take away the stigma of failure, to give them the chance to think that, yes, perhaps they should preemptively be looking at their illiquidity and sort of move forward with some sort of overall liability management, on their own, not necessarily invoking a common framework. But I want to just focus on two of the problems that I mentioned on the common framework, because it is important for its overall credibility and legitimacy. And the first is how the transparency point and how the IMF, who's always plays a central role in these restructurings, how it will use the key instrument that it deploys, the debt sustainability analysis, for persuading everybody on what needs to be done. And what sort of pain needs to be allocated amongst the various creditors, and indeed the country. So it's extremely important that what the IMF does with its debt sustainability has a broad acceptability by all the relevant creditors, and this in turn means that the all relevant debt has to be accounted for, and it means that it has to have transparency on what debt service amounts are, the types of debt, and the key terms that are of legitimate interest to everybody. Then that the perimeter of the debt to be restructured and the debt dynamic assumptions for that are appropriate and reasonable and understood by the community of creditors, and that all relevant creditors have and be seen to have a voice. And that, I think, lastly, because we tend to forget the debtor country is actually at the center of this, the debtor country has to be able to endorse genuinely for its own interest in this analysis and have a proposal to its creditors about its future post-restructuring role. And so that's going to be a challenge, because we haven't really done it before like that, because the DSA, which was an internal tool for the IMF, has not really been socialized in this way before. But I think that we'll have to try to see how we do it. Now, I'll just say one last thing about China, because it is the largest creditor in many of these countries, and it is important to think to see how they will react. So far, they have not been participating in multilateral efforts such as the Common Framework, but China is key not only because it already has large exposures, but it will continue to be a very large lender. It has huge trade surpluses and will have, for time to come, have excess money and capacity to invest. And we have to recognize that they didn't come to be the large creditor in these countries by design. In partly it was by design, but and partly also by accident, because lots of other creditors retreated after the global financial crisis. And China itself plays a role that traditionally has been played by multilateral development banks and other development financing infrastructure and energy, and it is important to consider, considering when we come back to see how these countries are going to grow, who will be providing this finance, and maybe persuade China to do it through new multilateral development entities. And ultimately, I think China has an interest in making this a success, because it itself does not want to add to its losses, which huge losses from from these loans. Already it has a domestic NPL problem. So that I think is important. Again, we should not demonize China. We should just nudge them to do the right thing and participate in this multilateral effort. So happy to discuss any of these things later.
Indeed. Yannis, thank you very much, and thanks to everybody for having very focused comments within the time frame. One thing I would like to do is actually, since it seems that I think most of you feel you all feel we have a bit of time, but we should use that time well in terms of trying to deal with the medium to longer term issue of over indebtedness among low income and emerging markets. And one of the ideas that that David mentioned, but I know that you all have views on, is GDP linked bonds. So I wonder if I could come to each of you quite just quickly and get your perspective. Two things really. One is, this is an old idea. It's been around for some time, but has its time come? And if so, what actually, why is that? And also, what would be needed now to actually make a big move in this space? So, but David, if I could come to you first on that, but if we could try and keep these as sort of brief and punchy comments, that'd be great. Yep.
So sorry.
Yep.
To answer your second question first, Creon, what's needed to make GDP-linked bonds a thing in emerging economies is for developed countries, or developed country officials at least, to sanction their use. The most important kind of precedent for this, in terms of what I'm thinking, is the way in which the changes to legal contracts to allow lower voting thresholds to bind creditors became a phenomenon 20 years ago. They're very commonly used now, and they became a phenomenon because the U.S. administration at the time gave a benign eye to the use of these clauses. So I think that the practicalities of this is that if GDP-linked bonds are going to become a more familiar feature of international capital markets, they will need the sanction of developed country governments to achieve that. In terms of the actual case, I mean, in some respects, contingency-related bonds, or bonds that pay out contingency-related returns, have been a feature of debt contracts for decades now, since the Brady Initiative created value recovery warrants to compensate creditors for the debt relief that they were providing to debtor countries 30 years ago. So the precedent is there in terms of value recovery. All that the link between, or the step you're taking between a value recovery bond or a value recovery warrant issued for Bulgaria or Uruguay's or Argentina's debt restructuring, the step from that to fully fledged GDP-linked bond, I think, is a very small one. And I think, as I said, for countries, for example, in South Africa and Brazil, in South Africa, for example, if you believe South Africa's inflation target, the current 20-year bond yield is something like 6% in real terms. The idea that South Africa will fail to have some kind of financial stability crisis with a 6% bond yield in real terms in an economy where growth potential is no more than 1.5% is crazy. So I think the best way to break this link, as I mentioned, between weak growth and rising public debt is GDP-linked bonds, and it will take the support of the US and perhaps the G20 to get there.
David, thank you. And Isabelle, your perspective on this from a markets or policy point of view.
Yeah, I'm a little more skeptical. I think the fact that the idea has been around for a while and that the instrument hasn't really picked up is telling us something. I think the reason why there's a large risk premium on South Africa debt has a lot to do with that fairly low growth potential that David alluded to, rather than anything else, frankly, that could be solved by, if you've got low GDP growth, having GDP-linked debt is not going to help you solve that particularly. And I think that what's happened in practice is that the GDP in emerging markets tends to be volatile, and certainly a lot more volatile than in developed markets. And as a result, investors are going to demand a risk premium or an extra risk premium to be compensated for this extra uncertainty. And once you add that extra risk premium, it just doesn't make it very appealing for the borrowers to use these kinds of instruments. Now, if it became a thing among advanced country issuers, would it help? Possibly, but I think you would be left with that fundamental asymmetry that there isn't that much volatility in advanced country GDPs, apart from when you're hit by a global pandemic, which we have to hope is not going to happen very often. And so I don't think you would see the same kind of positive contagion effect than we saw with collective action clauses, as David was saying. But again, there's nothing wrong in principle with the idea. It's just there's a risk premium, and that makes it unappealing to the borrowers, is all I would say.
Isabelle, thank you. And Yannis, I know you've worked a great deal in this area, so if you could sort of very briefly kind of either respond to Isabelle's concerns or maybe more to what David said.
Thank you very much. Well, obviously, I cannot respond to it. I'm a sort of market person the way Isabelle is, so I cannot respond really to this, other than to say that I do know that other market participants have a slightly different view on the possible risk premium. I want to defend the idea and just say why it has not been picked up. It has been around academically for a long time. I got involved in 2015 when a team from Bank of England and market participants asked me to write a term sheet for that, so to be able to engage with the markets, because until then it was just a policy, a discussion between policymakers. Nobody had provided something, kind of the legal instrument, and that's what we did. With what we dubbed as the London term sheet, to kind of just have a discussion. And what was interesting was that we did have this discussion. Again, the policymakers all, I think, unanimously thought it was a fantastic idea. I don't think the Bundesbank had ever been more enthusiastic about anything than this. And Bob Schiller, whose I think initial idea this was, also sort of came out with a triumphant article in the New York Times saying this is the next sort of big revolution. Now, why did they say that? They said it because it provides fiscal space in a downturn, and they are the ultimate catastrophe bonds. And if we think of natural disasters and sort of climate change, that could hit people, countries without sort of fault on their own, that provides the fiscal space, and it is very important. For me, what they do is they align long-term interest in growth. They're not just short-term liquidity. So in normal bonds, short-term liquidity in the country and day-to-day pricing matters, but sometimes the long-term is lost, and that is what the GDP-linked bonds bring. And they will help also with overall better disclosure. And if they are present even in small amounts, they will afford a better pricing also for the fixed rate bonds. Now, how do you kickstart it? I agree you wouldn't start with the countries that are now most in distress. Although I would note that we have examples of domestic GDP-linked bonds, I think in Portugal and Uruguay, or something variant of that in Uruguay. But you could say if say Canada or the US, obviously, or Germany, etc., were to issue and issue possibly with a trading partner, so as to even counterbalance the trade account differences. That could help kickstart the market, take away the stigma, and show that the premium is not necessarily that high. But I think it is a great idea, and I hope it will be followed up.
Indeed. Well, thank you very much for those quick perspectives. It's obviously an issue that I think the debate is going to continue, and maybe this will be the opportunity, but we'll have to see. But there's also another proposal I wanted to just raise with you now, because and it relates to one of the issues that came up earlier, which is we have this 500 billion of SDRs. A very substantial amount of it would not be used unless there are other mechanisms that are put in place to use it. And there are a number of ideas around. One idea links it to the funding of vaccine, another links it to some existing IMF instruments. But there's also an idea that Vera Songwe and the UN Economic Commission on Africa has put forward, which would essentially use a part of the SDR surplus to underpin a new international institution, which would provide liquidity to developing countries issuing debt. These would be developing countries with a rating, so not the poorest quality, but with a rating. And it would do so through creating a repo facility. Now, obviously, people would need to look at the detail of that in order to understand more greatly. But I think each of you have had a chance to sort of think a little bit about it. And I just wonder if you could give some initial perspectives on whether, in particular, this is an idea that is worth looking at further, particularly in relation to the use of an element of that SDR surplus. So, I mean, Isabelle, from a market point of view, perhaps I could come to you first and then to our other panelists as well after that.
Sure. Thank you, Creon. I mean, look, first of all, I think, the surplus we're talking about here is between 200 and, 350 billion SDR. So like a big chunk of the allocation. So any idea that entails looking at doing something useful with this is worth looking at. I think the immediate one that's been put on the table is what's been done before, namely having countries lend some of their surplus SDRs to the Poverty Reduction and Growth Trust of the IMF. That's better than doing nothing, but it's essentially just augmenting the concessional lending resources of the IMF. Again, definitely better than nothing, but it doesn't really do anything systemic that really would be aligned with the scale of the challenge that these countries face right now. So the idea of using it to help, from what I understand of this Vera Songwe proposal, which is very creative, to help create liquidity in the bond markets of the low income countries. Why not? I mean, I think there are. I mean, one question that comes to my mind is, a repo facility typically is something that provides liquidity to an investor base that is happy to own the instruments in the first place, apart from liquidity. Would there be a significantly wider investor base for low-income country paper just if you get that liquidity element? Conceivably, but if you're thinking parallel with sort of OECD country bonds that say a lot of banks hold on their balance, or insurance companies, there's going to be regulatory and ratings and capital requirement considerations that are still going to prevent all of these from holding the LIC bonds, even if there's a repo facility. But look, I think this should definitely be looked at. Another idea that I thought was unfairly or unfortunately overlooked is an idea that was put forward by some former colleagues at the IMF in the early 2000s. I think it was, namely, to create a green fund that would be capitalized with these surplus SDRs and then would leverage that allocation, borrow on markets in order to fund green projects in emerging markets. I think that sort of approach should be looked at again.
Yeah, indeed. Well, I mean, this may not be the only SDR issue that we have. So I think all of these ideas may be developed in future. David, perhaps I could come to you, and then Yannis, your perspective on this particular idea, or the surplus more generally.
Thank you. I mean, I think that in a way there's a sort of bit of a paradox in this question about SDR allocations. On the one hand, it's clear that, of the $650 billion worth of SDRs that will be issued, most of them will go to developed countries. But on the other hand, when you look at the extent to which an SDR allocation increases your foreign exchange reserves, most of the benefits are accruing to developing countries, to low-income countries who start off with low levels of reserves, and so any increase, sorry about my cat, any increase in global liquidity that comes to their accounts will represent a bigger increase. There is, I think, a need for redistribution. And as I understand the debate, the IMF is currently kind of focusing on using the Poverty Relief and Growth Trust, the PRGT, as the sort of mechanism by which a rich country receiving SDRs that it doesn't really need capitalizes or lends into this facility, and then that's used to supply additional liquidity or lend additional liquidity to developing country. On the question of whether repo markets and the way in which SDRs can be used to kind of, make repo markets work more effectively in this context, I'm just not sure, just because the countries that have the greatest need for this SDR liquidity are probably not the countries that have access to private capital markets. In other words, it's countries that are, that are too poor to have access to international capital markets that probably have the greatest need for the liquidity that can come from an SDR allocation. And a repo market in which private creditors are repoing bonds doesn't really address that problem, I think. So I don't want to kind of say anything bad about it, but it just seems to me that the countries that are most in need of additional liquidity may not benefit from the creation of repo markets with an allocation of this SDR.
David, thanks very much. I guess it does raise the question of whether it could yet be part of creating resilience for the future. So these are countries that kind of don't need it now, but potentially, through this development of this instrument, particularly if it has a broader impact, it could be useful in terms of making the whole system more robust. Yannis, over to you for your reflections on this idea.
Yeah, thank you. So I too think that you need to focus on what exactly you're using it for. Is this just a mechanism to help prevent crisis? Is it just there to boost liquidity when that is most needed? And is it there just to kind of help drop the yield temporarily? Well, that, as you just said, Creon, it may be very useful and very important in the years to come. But I think I would like to see the use of GDRs more in the way that Isabelle suggested with this old idea of the IMF, that to leverage that, to bring in also private capital and invest it towards the absolutely huge needs that some of these countries have to grow. They are the countries that will develop long-term the growth that the world sort of needs, and it has to be done right because of all the known sustainability risks, and that can be the way that we can sort of get that capital investment done with also proper governance. And also provide a means for sorting out what I mentioned earlier, with China sort of accidentally finding itself as the biggest investor in that space, bringing it in so as to have overall better goals, better governance, better design of the financing that deliver more sustainable growth. So I too, like David, think that it's not an idea to be attacked. I think the scheme is very good. I think if we want to use it as a defense mechanism when we have problems with liquidity, and that's very good, and we should have it as a tool. But I would like also to see the some other tool that looks for growth and that will help these countries that don't have the capacity, cannot produce the data, etc., to deliver the growth.
Yeah. Yannis, thank you very much. I mean, one thing I should have said is the idea, I think, is particularly to focus the repoing on debt issued by these countries which meets sustainability standards. So in a sense, there is a sort of element of linking this to that broader concern that a number of you have mentioned. Well, thank you so much. I mean, unfortunately, we're out of time. I think there's a lot more we could talk about, but I'm afraid this is we're now at the conclusion of this really interesting panel. So I would first like to get rid of my phone, which is ringing now and shouldn't be doing that. But anyway, firstly, let me thank the audience and also the organizers at Delphi Forum. But most of all, let me thank my three panelists for their participation in the event and their really excellent comments. And until we meet again, thank you very much. Bye, everybody.
Thank you.
Bye-bye.
Bye.